Similar to the equity markets, the fixed income markets have experienced more volatility than we've seen in recent years. And obviously, the first point or data point that the markets are looking at when they try to figure out why is fixed income going down, why is my bond portfolio, which has gone up pretty much consistently for 35 years, suddenly showing volatility? Well, the first answer is the Federal Reserve. As we look at the first chart, we'll see in the orange the history of the Federal Reserve's monetary policy, raising rates, lowering rates. And so we've had two bear markets here in 2000 and in 2008. And we see that the Federal Reserve is very aggressive in reducing rates. Now, traditionally what happens is the Fed reduces rates, stimulates the economy, and then puts the rates back to normal levels so the economy can run efficiently. Well, what's happened over the last several years is we've come out of the Great Recession. The economy has continued to grow 9 years now, but the Federal Reserve left monetary policy very accommodative. Well, this is absolute distortion in the marketplace. So as we can see, the Fed right now is playing catch up. It has to raise rates. It has to bring the rate level up to an acceptable rate that matches the growth of the economy. Why is this important? Because this is driving bond yields higher, which pushes down bond pricing. So the chart shows this step-by-step move, and we're hearing from the Fed they're going to keep doing this. So the question is, are we now in a tight monetary policy? Because historically, bear markets and really problematic bond markets happen when the Fed gets aggressive and takes us into a tightening policy. Well, our view on this is the Fed isn't necessarily tightening or hasn't become hawkish, they're normalizing. And that's the key word here. They are so far from where this should be that these moves are just bringing up the level of bonds to where they should be. So the obvious concern then is the Federal Reserve tightening? Are they becoming hawkish? Are they going to continue to raise rates to try to pull the economy back from an accelerated growth pattern? Why does the Fed do that? To stop inflation. Well, we don't necessarily see runaway inflation yet. It's starting to pick up, but it's not accelerating to the level where the Federal Reserve has to be aggressive. The word that's important on these charts is normalization. It's not being hawkish, it's not being aggressive. They've just been so overly accommodative for so long. Now's the time for them to bring rates up just to bring it back to normal. And in fact, if we look at the chart on the right, we're not nearly back to tight policy. As the chart shows that the real Fed funds rate is actually still below what we think the average has been and where they should be. One of our themes in the 2018 year ahead review was the unwind of the great bond bull market. Now, this bond bull market has been going on for 37 years. And for roughly the last 37 years, we have seen bond yields just go straight down. Well, again, yields go down, bond prices go up, they become more valuable. The reverse is true. And so what we're seeing in 2018 is a very important pivot moment where bond yields have broken out of that 37-year trend. The 10-year Treasury has broken through. It's touched or gotten close to 3% a couple times. It continues to pull back and go back and forth. Our view is that we are beginning the process of unwinding this great bull market in bonds and beginning the next wave, which we believe is going to be a secular bear market in bonds, where yields will go higher consistently over time. The economy sets up well for that. The Fed sets up well for that. Inflation sets up well for that. So as we look at the chart on the left, we'll see that the 10-year Treasury actually hit a price it saw not for 4 years. We think it's going to break out of the threes, and we think we're going to see higher yields. And that means we have to be very careful in our bond portfolios, because if we own long bonds and these yields continue to go up, the value of our bonds go down very, very quickly. As we look at weakness in the broad-based markets, what it shows us is, on the right, is in 2018, the Barclays aggregate year-to-date return was negative. The Barclays aggregate is kind of all bonds. It's corporates, it's governments, it's longer durations. Not a good year for the Barclays, and one of the worst years since 1996. So the bond market right now, which has been a place to just put money and go to sleep, it always works, is suddenly starting to become challenging and is going to require a more thoughtful process in allocating funds. Also, We don't want to be in the wrong place at the wrong time. As we discussed earlier in the economics section, the government is starting to spend more. We have this new spending bill. We're going to spend more. The economy is going to be driven more by government spending than it has been in the last couple of years. Well, as we know, the United States doesn't have the money to spend. That means they have to go out and they have to borrow it. And as we look over the last couple of years with sequester and paying down and low interest rates, we've seen that in 2014, 2015, the amount of money the government was borrowing was coming down. Well, that's reversing. And over the next few years, in 2018, 19, 20, we expect borrowing to go up significantly. Well, this is important because if we have too much supply and not enough buyers, what happens to price? And in this case, price is yield. Yield has to go higher. You need to draw buyers to the market to consume all of this supply. Yields go up, bond prices go down. So this is another factor on top of the others that we've mentioned that causes us concern in bond portfolios. So what do? We play defense. The answer is when a bond market is turning in the manner in which this is, you start to play defense. Well, there's a couple ways to do that. As we said, short bonds are safer than long bonds. There's less volatility and there's less downturn in a rising interest rate market. So our portfolios have to remain short and they have to remain safe. What also can be a big benefit is if we can get floating rates. So part of our allocation in our portfolios is corporate floating rate bonds. They're high quality credits, but the important aspect of this bond is the interest rate actually floats with the market. Suddenly I take interest rate risk out of the picture if my interest rate goes up with interest rates. And so that floating rate becomes a great risk aversion in a rising interest rate market. Floating rate notes, how they outperform during rising interest rate periods. So here's several periods where rates actually started to rise, and we'll see 10-year Treasury performance was actually quite poor, averaging down 7.7 for all of these different periods. The Barclays aggregate, because it had high yields and because it had one particular year in 08 through 10, which was a recovery of the high yield market, did well. Pull that out, and the Barclays does not do well. Look at floating rates, consistently good in rising interest rate markets. So our defensive posture today is we want to make sure we're short. We'd love to have more floating rates. And on this next chart, we also want to be very careful with credit quality. High yield bonds traditionally will trade based on economic expectation. Well, today, economic expectation is that things are good. And so therefore, the price of high yield bonds is high. There's a low expectation of defaults. There's something called a spread. This chart shows the spread between high yield bonds and treasuries. That's the difference in the rate of return between a high yield or junk bond and a treasury. I want to go back and I want to remind us, we want to buy low and sell high. So what this chart shows is when the chart is high, that means spreads are wide, people are worried. When people are worried, price is crashing and the spread goes high. One of the greatest times in history to buy high yield bonds was back in 2008. The spread to treasuries, 18%. That means a treasury is paying 2% and a high yield bond was paying 20% interest rates. And the reason is because everybody was panicked. They thought the world was coming to an end. So what happened? They bought these 20% bonds. The markets corrected. Those spreads came all the way back to about 5%, and the price of those bonds skyrocketed. So when the spreads are high, prices are cheap. Where are we today? We're at about 3%. We're at one of the lowest levels we've seen in decades. That means prices are high. Put simply, do you want to take on the risk of a junk bond for a mere 3% more than a treasury? It just doesn't seem worth it to us. So again, we're going to play defense and we're going to stay with the higher credit qualities, and we'll wait for a better pricing opportunity to go back into high yield.